$74 billion slipped out of Enron's off-balance sheet books and disappeared from Wall Street's view in just one afternoon. It was 2:17 p.m. On August 14, 2001, when NYMEX traders saw a weird jump. Enron's earnings suddenly rose $5 million, but its real liabilities were inflating way beyond what the filings showed. Who was to blame? A tangle of special-purpose entities that let Enron hide debt the way a magician pulls a rabbit out of a hat, leaving investors clueless. A few weeks later, the house of cards started to shake. Jeffrey Skilling, the CEO at the time, told the board that Enron was the most innovative company on earth. Under his bravado, the finance crew, headed by CFO Andrew Fastow, was cooking the books, morphing $74 billion of concealed obligations into future revenue. Fastow teamed up with the notorious LJM and Chewco entities, letting Enron log deals as if cash were on hand, while the actual debt lingered quietly in the dark. The fallout? It was massive. Once the truth came out, the stock plunged from about $90 a share to under $1 in just a few days. Investors watched their holdings vanish, and the whole market felt the tremor of a $74 billion hole tearing through corporate America's fabric. So why should you care? Because Enron's downfall didn't just wipe out a few execs. It rewrote regulatory oversight, sparked the Sarbanes Oxley Act, and left a legacy that still haunts how today's tech giants do their accounting. I've combed through court filings, SEC reports, and the original balance sheets to trace the line linking the hidden debt to the market crash that still echoes on Wall Street. Source: Wikipedia. What actually went on behind those polished earnings calls? How did a few accountants persuade auditors that $74 billion could vanish without a trace? And what can we take away before the next, Enron-style, scheme tries the same trick? Stick with me while we peel back the layers of deception, expose how the accounting tricks worked, and follow the ripple of that $74 billion shockwave still reverberating through the halls of power. Source: Southmount Inc., Edu. By the end, you'll understand why the Enron saga is more than a cautionary tale. It's a blueprint showing how hidden debt can shake an entire financial system, and why the watchdogs we count on may still be a step behind. Source: Scribd. Ready to dive in? Back in the early 1980s, Enron was just a basic pipeline outfit, but fast forward to the late 90s, and it was all about being this flashy energy trading giant. They ditched the whole owning physical stuff thing and got into buying, selling, and trading electricity and natural gas contracts, basically gambling on price swings like some hedge fund hotshot. Their annual reports bragged about over $100 billion in assets while calling themselves asset-light, which, spoiler alert, was total nonsense. That whole charade, built on two sneaky accounting moves that turned a cash flow disaster into eye-popping profits. First, there's mark-to-market. Enron's traders could ink a long-term gas deal today, and just like that, slap the present value of all future cash flows onto their revenue ledger. Originally meant for securities, this rule let them claim profits the second a contract was signed, whether cash ever showed up or not. They got real creative with their discount rates, often betting gas prices would just keep climbing forever. One contract could suddenly pump up earnings by hundreds of millions in a single quarter. Source: Wikipedia. Then you've got the real mess: special purpose entities, SPEs. CFO Andrew Fastow cooked up a ton of these off-the-books partnerships, names like LJM1, LJM2, and Chewco. Enron would dump their underperforming assets into these SPEs, then call it a sale that magically wiped debt off their main books. Since the SPEs were legally separate in theory, those liabilities vanished from Enron's consolidated statements, but the company still raked in any future gains. To keep the scam alive, Fastow struck skin-in-the-game deals where Enron kept a teeny equity stake, just enough, barely 1%, to make it look like they had real risk. Source: Southmount Inc., Edu. And here's the kicker: the Sarbanes Oxley rules that would have forced Enron to come clean about these SPEs didn't even exist yet. Auditors at Arthur Andersen rubber-stamped the whole thing, playing fast and loose with the rules and relying on Enron's own shady valuations. Clean balance sheet on paper, but hidden liabilities, piling up like unpaid bills in a junk drawer. Source: Scribd. Now, none of this would have worked without the key players feeding the madness. CEO Jeff Skilling, the guy who pushed Enron's rank-and-file trading frenzy, was all in on mark-to-market. His motto: "The market's always right." He drilled into employees that the only thing that mattered was real-time earnings. Translation: traders got rewarded for booking revenue, not for actually bringing in cash. Source: Wikipedia. Meanwhile, Fasto, architect of the SBE empire, used his financial street smarts to bury $1.2 billion in debt from nosy investors and analysts. He rigged the partnership so losses stayed buried in the SBEs, while any profits got funneled back to Enron's income statement as gains from equity investments. Double-dipping at its finest. Enron reported profits soaring to $5.8 billion in 2000, up from the year before, while the real cash flow shrinking faster than a wool sweater in hot water. Source: EBSCO C. So yeah, mark-to-market plus a web of SBEs painted Enron as this unstoppable, debt-free titan. The numbers? Glowing. The reality? A ticking time bomb of hidden obligations just waiting for the market to flip. And flip it did. Late 2001 rolled around, the whole rickety house collapsed, and Wall Street got hit with a $74 billion gut punch that's still talked about today. The first alarm sounded in August 2001, when a junior accountant, Sharon Watkins, slipped a secret memo onto Ken Lay's desk, warning that Enron's risk-taking business model was nothing more than a house of cards. She warned the CEO that the company could implode unless the hidden debt was exposed. That note became the spark the instant the whistleblower's voice pierced Enron's polished PR veneer. Source: Wikipedia. Fast forward a few weeks and the storm broke. A federal probe uncovered a massive $74 billion ruse off balance sheet entities, bogus energy trades, and profits that existed only on paper. SEC filings revealed Enron had been shuffling debt into special purpose vehicles, inflating earnings and misleading investors. Source: Wikipedia. The scale was jaw-dropping, a $74 billion illusion that had buoyed a stock once trading above $90 per share. Then the implosion happened. On December 2, 2001, Enron filed for Chapter 11, then the biggest corporate bankruptcy in U.S. history. The news slammed the markets like a freight train. The Dow nosedived and the energy sector shivered. Source: Southmount Inc. Edu. Investors saw Enron's share price melt from the 90s highs to mere pennies in just days. Legal fallout came fast and hard. Jeffrey Skilling, the architect of the trading empire, received a 24-year sentence, later reduced, while former CEO Kenneth Lay got a 10-year term before his untimely death in 2006. Beat text pop, hundreds of rank-and-file workers got caught in the crossfire, and the scandal ignited a slew of reforms, most prominently the Sarbanes Oxley Act, which tightened corporate accounting standards. Source: Scribd. The market panic wasn't merely digits on a screen. It was a loss of confidence that spread across Wall Street. Analysts dubbed it the day the market learned that numbers could be invented. The Enron collapse forced investors, regulators, and CEOs to confront the very real cost of corporate deception. Source: EBSCO C. In the end, the $74 billion mirage didn't just vanish. It scarred the financial system, a cautionary tale that still haunts every quarterly earnings call. So here's the deal: Enron didn't just implode back in 2001. It shattered the whole notion that Wall Street could police its own backyard. Those phantom firms hoarding billions, think smoke and mirrors, and when the curtain fell, investors got scorched real bad. Now here's where it gets creepy. The same tricks Enron wielded off balance sheet gimmicks, bogus profits, are still roaming around. Just glance at Wirecard or at the 2023 implosion of a $30 billion Chinese behemoth. The red flags remain identical: excessive complexity, scant transparency. So what's the takeaway? If a firm's books resemble a Rubik's Cube that no one bothered to solve, bolt. Sure, regulators have stacked on extra rules since Enron, but human greed. It stays the same. Want to stay ahead of the curve? Hit subscribe. We dive into the financial frauds the headlines miss. Because the next Enron, it's already simmering somewhere, and you won't spot it coming unless you know where to look.